offered a little bit on the corn side, but they haven't been totally restrictive. There's definitely some potential in the ethanol demand, so that's been a hot topic. But right now, as I flew in, there is a lot of green out there, especially in the Corn Belt. So we talk about big corn, wheat, soybeans, those big key commodities, things are looking pretty good. We've got a big WASDE report coming up on July 11th. That's the first chance that we have coming out of the June 30th acreage report, where we combine those yields and acres. We will know where we're sitting as those yields might be adjusted with the WASDE report. And so be paying attention to that. That will dictate whether we deviate above or below our trendline yields that are listed here. If that happens, we will have a market mover one way or the other. So something to be thinking about. If we look at a 15.8 billion bushel corn crop, that would be with the projected acreage and trendline yield. Those are the numbers that we might see change in that report. Same goes with soybeans. We're still at that trend line, 52.5 bushel per acre yield. So that would put us just a little over 4.3 billion bushels of soybeans. These are big crops, guys, and these are the reasons why we're putting some downward pressure on prices. So it's a tough year to be a grain farmer here. When we look at our cash receipts, our net farm income across the board, pay attention to kind of what happened here. So we can see kind of the post-COVID where we had a lot of government ad hoc spending on top of our cash receipts. This was some pretty tough times. Then we saw some prices start to come up as our government assistance went down. And we take a look where we are, we can see that additional economic assistance package that showed up here with some higher receipts. So while we still got cash receipts, what do you think's keeping those up? It's definitely not coming from our grains, so we know it's coming from our livestock. The biggest drivers here are coming from eggs and cattle. And when these numbers were assembled, the pork prices weren't quite as good. We've seen cash come up to that 106 level at times, so we've seen things a lot higher. That's increased. So our receipts overall are probably a little higher than where they are. So take a look at this. Here we've got our cash receipts for our big major crops. We got our corn, wheat, soybeans, all the way down to our rice. So we see this downward slope here in thinking about that. Now watch what happens when I switch to our production costs. We have the opposite thing at play. And this is the reason why we're struggling so much, because we saw this inflation get rolling. When inflation drove up those prices, those costs, they've not come back down. And we always hear the news getting all crazy about, inflation's cooling, this and that, but what they forget to mention is that when inflation cools, prices don't come back down. Slower inflation means things are getting expensive slower, more slowly. And so that's kind of where we're at. We have these decreasing prices with increasing production costs. And that message is crucial as we go through and we talk about what's happening in grains country. This all relates to our production and livestock. So whether we're talking a cattle feedlot or feeding hogs, these lower prices here are providing opportunities. And when we're talking about hog production, that's what we want to focus on. We heard Dr. Newman talk a lot about this. There's a lot of opportunity here. And while I don't like to put different sectors of agriculture against each other, there are trade-offs, and we have to remember that. So I'm going to start with cattle and work my way through, because this is important to what our beef demand, or what our pork demand looks like. So going back to 2022, look at our drought conditions. We're in a La Nina trend. This is when our inflation really took off, was in this 2022 timeframe. Our cattle inventory was pretty high, hog inventory was rather low. We had some good prices for hogs during this time. 2023, we have some drought improvement. We have a little bit lower inflation rate, but what's happening during this time? We have low cattle prices and we have interest rates starting to increase as the Fed combats inflation. So the cost of borrowing credit's getting harder. It's getting higher. Banks are getting more skeptical. And we have one of the worst years for hog producers in history in terms of profitability. 2024, some drought improvements, inflation rates coming back down. We have a cattle inventory at a little over 87 million. At this point, we've hit the lowest cattle inventory we've had in 74 years, since 1951. Hog inventories come up a little bit. Here we move into 2025. Drought's kind of creeping back in. So when we think about this and what was happening this spring, there were calves hitting the ground. They don't have to make decisions based on these calves in most circumstances until the fall. So we're down another 1 to 2% here to bring the cattle inventory even a little bit lower. And right now, that's what's leading us to record beef prices. So we have record cattle prices, we have record wholesale prices, we have record retail prices. And as some of these numbers come out, I expect June to be that record-breaking month. Here we see a little bit of drought improvement, and that's where we're at right now. We've seen some of these storms come through. If you were up in the Dakotas where my family farm sits, we had some serious storms come through. We had 5 to 8 tornadoes hit the ground and basically move across the entire state from west to east. It was devastating. So there's some crop damage in there. And that's something to be thinking about when we go into those yield estimates like I talked about before. There's definitely some damage out there. I don't know if it'll be enough to move the needle on some of these yield projections, but it's something to keep in the back of your mind. Looking at our supply and our cattle inventory, we're down about 2%. We didn't have the July cattle report last year. USDA did away with it. They had some funding issues, some money allocation issues. That's been squared away. We will have that July cattle inventory back. And so we will know the important piece of this, which is the calf crop. This is what's gonna make the difference in telling us where we're headed in our decision making with livestock or with cattle. That calf crop for this first half of the year will be what they have to choose from to keep or to market as we go into the next year. And this brings me to the next point when we talk about the cattle cycle. And a lot of people balk at me when I talk about the cattle cycle. This is important right now. We are not in a typical cattle cycle. We've been in the contraction phase for 7 years of a 12-year cycle this far. And if you think about what's in the pipeline, those calves that I talked about for the first half of the year, when they make decisions of whether to market those, whether to withhold some of these animals, what got us here is we marketed a particularly high number of female cattle due to the drought conditions. That has continued. Right now, it's at about a 50-50 split, but we're still marketing a high number of heifers. And so as we go into fall, those calves that are hitting the ground, even if we retain those calves, it's a year until they are mature enough to be bred, and it's another, basically year until they put a calf on the ground. So we're looking at 2 years yet before we can have meaningful expansion in the cattle herd. That means our supplies are gonna stay tight. That will be a driver for our prices. When you think about that in respect to pork, that provides an opportunity. Because when we're producing expensive beef, it's still in demand. Demand for beef is still there. But how long can that withhold and withstand these high prices? That's where the opportunity comes in. So here you can kind of see where we're at. You can see that curve is flattened out a little bit. If we look at the cycle, there have been longer cycles than the one we're in now. We had a 14-year stint there between 1990 and 2004. And so we're not quite out of what is considered possible here. This isn't that extreme. But the unique set of circumstances is that there's more obstacles in the way than there have been in the past. These high interest rates, if we think about what it means, the average age of the farmer is 58 and a half years old. Now put yourself in his shoes where you have these high cattle prices and you have to decide whether to grow and expand, or maybe this is a good time to get out. When you look at the cost of capital, I can't find an operating note that's 6%. It's not out there. It's more likely between 6 and 8%. And so if you think about these prices for heifers, if you want to grow your operation, if you want to grow by 25 head, and especially if you're a younger, somebody that has to get credit for capital, to go and buy 25 head, you're talking about writing a 6-figure check at 6 to 8% interest. That's a pretty tough business incentive. It doesn't work. And so that's what we're looking at and why there's some serious obstacles into growing this herd again. Here we can see the prices for our fed steers. These are where we're at. We've set records on countless occasions this spring as we've continued to get our fed steers. Our cold storage continues to go down. As our supplies go down, our consumption has remained solid, and that's why we're seeing a reduction in cold storage. And so all eyes right now related to beef are on these high prices, tariffs, and demand. And I'll talk a little bit more about the tariffs as we get into some of the hog stuff here. Our lower inventory numbers and our uncertainty are going to keep this market volatility high. It's very difficult to fathom expansion. If we lose demand and our cattle prices start to drop, there's even less incentive there to grow than we have now. Choice beef is breaking records. And that means our consumer is still hanging on and paying for that premium product. But how long can that hold on? Switching over to hogs. And everybody's gonna laugh when I put these guys up. These are some of my favorites. But we had a stint there where we raised a few Mangalitsa's, and they were some of the best pork we've ever had. It's really an amazing quality product. They're very, very fat hog. Very, very hardy in the North Dakota climate. But they were good stuff. Conditions have improved. We're in a pretty good year right now. But we've got to remember how bad a lot of people are coming out of 2023. One of the worst years in history for profitability. So how long does it take to make up for the damage that was caused in 2023? There is a huge opportunity here to grow the market share of domestic consumption for pork. There's a lot of challenges with export markets, but the good news is so far, a lot of those exports have held strong. And even though we've lost a good chunk of China with some of the tariff situations, there's still a lot of positive things happening, especially with some of our Latin American markets. But we got to remember the big elephant in the room, and that's always China. If we combine 3 or 4 of those markets, that's still not enough to make up for the loss of China in these markets. China's market is absolutely massive. That's why we will hammer on that as economists and marketing experts continually. So if we look at our net slaughter hog prices, our prices are pretty good right now. When we look at cash coming in over 100 per quarter weight, 106, those levels, our cash prices are going pretty good right now. And there's opportunities here. If I'm in this position and I'm looking at these, I'm thinking about my risk management tools. Things are good here. If we see, the Hogs and Pigs report will be out by the time I'm done with this presentation. We will know what our pigs saved per litter are. This has the potential to move the needle on the markets a little bit. And that's when we need to be making decisions and writing these things down with our marketing plans so that when this happens, we know when to pull the trigger. And we also know what we're doing when we pull it. So I'd be amiss if I didn't put this slide up, because this is a slide that gets used over and over and over and over across the country. I do not talk about hogs without using this slide. And this one in particular right now is so important because of that 2023 drop. What this is if we look at a 2,500 head sow operation, that is $300,000 to $400,000 in losses per quarter. That's hard to fathom. And so that's a story that when we talk about profitability and what we're looking forward, we have these deep red lines, and we're trying to make up for all that with these little bitty black lines. We still got a ways to go. So with respect to the meat side of things and our consumer, this is our choice select beef cutout value. And that's kind of what I'm showing you to demonstrate. When this is wide, that can be a sign of increased consumer demand for beef. When we start to narrow, under $10, that can be a sign that we're starting to see demand slow and they're not as willing to pay for that premium product. These have moved up, they've come together, they've spread apart, and I've thought multiple times as we've approached the 4th of July that we were going to lose some demand here, and yet it keeps going. This changed when we hit the COVID era. That's when the United States really started developing that taste and preference for beef. But if we look at where these prices at, how long can that sustain before we start changing to the other substitutes? And so that's a lot of what Dr. Newman talked about here is when we see this, that's where the real opportunity comes in. Pork has been looking for demand for years here. It's been roughly consistent with the disappearance over the last 5 to 10 years. And this is the sign to me that there's an opportunity here. And so a lot of that, your checkoff dollars, going towards that promotion and shifting gears is a major opportunity. So taking a look at the consumer sentiment. If we look at our disappearance, on the beef side of things, we're up from both 23 and 24. If we look at our pork use, we're up from last year. We're a little bit down from 2023. Cold storage, the story's starting to change. If we looked at what last month's cold storage was, it was up 11% month to month, even though we're still down a little bit from last year. We had a lot of production that got pushed through in that last month. May change things. We saw the production slow down. Our cold storage, that picture is not quite the same this month as it was last month. Our consumer demand is still kind of supporting beef as we're going through this grilling season, but that is starting to change. And with our record prices and the continued economic uncertainty, I think there's a lot of potential to see a shift there. If we look at our trade in some of our foreign markets, paying attention to what our exports look like to our top export markets, our exporters totaled around 3.4 million metric tons. This is up from last year. We're moving more pork throughout the world year over year. And that shows us that the global demand is there, which explains why we're exporting so much pork from our production. When we think about that being close to 30% of our overall market, that's pretty monumental. The hard part comes in when we talk about Brazil. Here you can clearly see where we sit in terms of the best pricing for pork production. The EU has let things get out of hand. We're pretty competitive with Canada, but the cost of buying Brazilian pork is still much lower than the rest of the world. And we've seen that currency depreciate so far. You know, that gives them a natural advantage. And the thing about a currency devaluation is it takes a long time to change that to rebuild it. And so this slide came from the US Meat and Export Federation. We do a lot of work with them, and they put together wonderful pieces. The amount of content that they put out is astonishing at times. So if you don't have access to that, that's something to consider. Looking at our tariff situation, this changes daily. And I kid you not, this slide is the same slide that I started with before the reciprocal tariffs occurred. We have gone back and forth with other countries, with the courts, and if you think you know what's going to happen today, wait till tomorrow. Right now, China has a 35% tariff on US beef. They have not renewed any of the plant certifications that allow us to export beef to China. And thus, our exports are down about 10% from 2024. Month to month, they're down about 38%. And so if we look at our largest importers here, South Korea, Japan, China has dropped from number 1 to number 3. Looking at the pork situation, 57% tariff on pork going into China still exists. The total exports as of last week, a little over 53,000 metric tons, down 37% from last year. Total exports forecast down around 2% from last year. I expect that number to change as the year progresses. Our largest importer by far is Mexico. That partnership continues to serve us well. So I think as we kind of wrap this up on the marketing side of things, there's a massive amount of uncertainty in livestock markets. There's concerns over recession as the overall arching economy sits and waits on some of these tariff decisions, what's going to happen with our foreign countries. Our stock market is up and down. I've seen discussions on currency devaluation, you name it. We have futures going down, we have futures coming back up, and that gives us a very high degree of market volatility. On the cash side of things, record prices are going to continue in beef until consumer demand stops supporting them. Cash hogs are up 25% from 2024. Prices for grains are well below break-evens. So I think the story is pretty well laid out in those last 3 bullet points. With record prices, demand can come in. There's an opportunity for pork to be a part of that. With those prices up, this should be a hint to be paying attention to your risk management, because those higher prices for hogs are not going to last forever. And then I'm going to talk about the wild cards, and this is relevant for hog producers as well as cattle producers. On November 22nd of last year, a case of New World screwworm was identified in Chiapas, Mexico. Now, this parasitic pest is an understatement. These little guys are terrible. We have now been over 1,800 cases. The way we control these guys is we release sterile flies into the environment by plane. They breed and they lay sterile eggs. And so we effectively eradicated this guy in 1966. What this thing does is it can be a lesion as small as a tick bite. Eggs are laid on the animal, the larvae hatch, they burrow their way into that lesion, whatever it might be, and they basically create a big open gaping wound as they burrow into the animal. Now, when this happens, that animal is then susceptible to infection. It's difficult. I mean, there's ways of treatment, but at what point do you draw the line before the animal, is infected to the point where we're septic, where another infection takes hold, and where it's no longer, feasible to keep it in the production pipeline? We got this thing out of the US in 1966. It took until 2000 to push it down to Panama. So this is not a quick fix. About a month ago, they crossed the threshold that we had adequate coverage to contain this pest within. When it crossed that secondary boundary in Oaxaca, Mexico, and in Veracruz, we no longer have the ability to produce enough sterile flies to push the thing further south and to keep it from moving further north. And something that's kind of curious here about, this guy, it has about a 12-mile range that it can move from its host. Well, 60% of the cattle in Mexico are free-range cattle. They're worth nothing when they're down here in some of these other Central American countries. When they cross that border, they're worth about $500 a piece. By the time they get to the US border, we're talking $2,000 to $2,500. So there's a huge incentive to move cattle northward through Mexico. If New World screwworm were found in the US, there's an ERS study that indicates that kind of replicated the 1976 outbreak in Texas. And by their estimations of the current number of head in Texas, their estimations for the initial economic cost would have been about $1.9 billion. I think this is extremely conservative. And when we think about that, that's just for one state and for one set of eradication methods, if we had enough flies to eradicate it. So we had ports open for a little bit. It took a lot of a back and forth between Seneca, which is Mexico's version of APHIS, and APHIS. The discussions were kind of set. They opened the ports up on agreed upon terms for cattle movement. When they found those two cases in Oaxaca and Veracruz, they were shut down indefinitely again, and they will not open until we get this thing under control. So with that, that's kind of we got to pay attention to some of these wild cards, is my point. And that's relevant when we talk about leading our farm. So I want to talk about the state of our economy here. I'm going to watch my time a little bit because we're getting tight. We're talking about an ag recession. Lower commodity prices are the biggest issue pushing this alongside of our higher production costs. Borrowing money right now to purchase equipment and livestock is expensive. And this can eat up your farm's working capital very fast. This is one of the first times in my lifetime that we've talked about interest expense as a ratio to your revenue. You want to see how expensive that debt is? Pay attention to your ratio, how much you're spending to service your debt compared to what you're bringing in. We can use lessons of the past to work our way through this and lead our business through this. This is a lot like the 80s, but there are some very key differences, and there's some things that we can do to work our way through this. Our interest rates are high, but they're not 20% high. And because of that, land values have held. So we still have land values that are steady and some are increasing. And so that gives us an asset to borrow against. So the access to credit is there, but it is costly. So you need to spend that money wisely. This is not the year to invest in unproductive assets. If you're a new farmer, a new beginning farmer, that is something to keep top of mind. Monitor your spending. You are particularly vulnerable because you don't have that equity to borrow against. Livestock prices are a lot better for now, but we got to remember that the cure for high prices is always high prices. How do you buy into this? How do you make money in that business model? Those are all questions you need to be asking when you put together a plan to grow. So something to keep an eye on, and I like to talk about this because this helps you gauge what the credit situation looks like and what your lenders are looking for when you come to the bank. The American Banking Association puts out an ag lender survey every year. It comes out just before Thanksgiving. And this gives you kind of a feel of what the lending industry is thinking and what's going on there, what their biggest issues are. Last year, they were concerned about the pullback in profitability, specifically on the grain side. Liquidity has started to become an issue. That means that capital that I was talking about that can service any of your costs, your debt, your annual cost to the farm, that's a concern for your lender. If they're concerned about that, you should be too. Delinquencies and loans were relatively stable for last year, but they expected credit to kind of fall apart through the next 12 months. And it's not, and when I say fall apart, I don't mean completely fall through the floor. I just mean that credit conditions will become a little bit more challenging than they had in the past. This has happened. You know, as we went into the spring, there was a lot of lenders that I was getting phone calls and messages from that were handing out their borrowers' rights with regards to their current status of their loans and credit situation. That is a hard pill to swallow. And so while those land values continue to hold, this should help keep some of this, some of the lending and loan portfolios relatively stable. But you got to remember that every time you do a refinance, that's one more resource that you have taken off the table. And so those should be used with the utmost critical approach. And this brings us back to leadership in hard times and some of the things that Gretchen talked about earlier on. Now, I wrote some of these down. Leadership, the ability to lead your farm is an honor and a privilege. In the worst times, you cannot show vulnerability or fear. In the face of fear, have confidence. These are all things that we can take when we lead our family farm through whatever hardships are coming our way. They give us the ability to build those relationships, to talk to people, to talk with your lender. What's good for you is good for them. Monitor your spending. Invest in productive assets. Manage around the controllables. Manage around the uncontrollables. And I preached that really hard as I was a student. I went to the Dr. David Cole's Ag Lending School, and I will never forget him talking about that. What this comes down to is this stuff is hard. It's stressful. And that's the last thing that I want to kind of leave you with is our Farm Bureau's Farm State of Mind campaign. We talk about not showing vulnerability when you're facing your fears, but what happens when you can't do that? What happens when you're taking on that pressure? As President Duvall would say, it's okay not to be okay, but it's not okay to not talk about it. And so we put together this campaign that helps bring farmers together and provide resources and counseling and access to resources in these hard times when you're not able to get up on your own and you need your rope team. Or maybe somebody on your rope team needs you to be there for them until they can get up. This is a strength. This isn't a weakness. But as somebody that's been in some of those places, that first step is it's the hardest thing you can imagine. If anyone's ever been there, they understand what I'm talking about. But getting help and admitting that you're in the same spot, it's human. We are all human. We are all flawed, and we all have hard times. And that's why we need our rope team to reach out for help. I've talked to people firsthand that have been ready not to come back. And they were able to call that 988 number that's on your screen right now. And they're here today because of that. And so when I talk about that leadership, when you fall or when somebody else that you know is falling, That's what takes the real courage, is to help them up, or to reach out for help when you need help up. And so with that, with all this talk, I know this is a little bit of a dark subject to kind of end with. I'll leave you with the charge. And that's when somebody else or yourself is seeing darkness, reach out and be that light in that darkness. You can see all of these topics, whether it be marketing or policy related, on our market intel page. That's fb.org/marketintel. We put out roughly about 2 articles a week on this page, whether it be related to the Farm Bill or market conditions, a report that came out. It could be shipping related or trade related. You'll see those put into kind of some short digestible documents that we do our best as an econ team with American Farm Bureau to kind of keep those short, sweet, and something that's easily understood. I encourage you to sign up for that. It's a subscription, it's free. It just puts you on our email list and notifies you when something comes out. Take a look. And at that, got time for questions with 2 minutes longer than I had before.
Are there any questions from the audience? Okay.
With the bean meal crush being 20% higher than it was a couple years ago, and biodiesel rules are changing, do we have any insight on how these rules are going to change, what's going to happen? We've already had one company that's pricing beans 16 cents under November price, and they're not buying anything now on today's price.
Well, first I'll warn you, I'm not the 45Z or biofuel expert. That's a little bit outside of my realm. It's something that I occasionally keep up with. But with crush, I can tell you this, is that we still have far more capacity than we're even close for on our RFS models. You know, what we've got for the mandates is far below what we're capable of doing. We are struggling a little bit with meal, as trying to send it someplace where we need to get rid of it. And so that's been one area that if you're operating a crush plant, that's still a little bit challenging, is how to handle the meal, where it goes. It needs a home, but they're having trouble moving it, and that's been a little bit of a restricting factor. We're going to have to do something with these rules. There's no question about it. It'll continue to be a top priority. I don't think it's going to be quick. If there's anything I've learned, we talk about moving things through Congress and the discussions behind this. It has not been easy to move this stuff. The discussions happen, but getting it to move has been a different ballgame. We do have people in our corner that we work with on it, but it's a continued battle, and that battle will continue. There's definitely opportunity there, but don't expect it to be quick.
What are the main bottlenecks of moving the bean meal?
Say that again, I couldn't quite hear it.
What's the biggest bottleneck of moving bean meal?
I honestly couldn't tell you. I think just finding the demand and the feed source for it, because right now we're down in inventories. We're not moving it within the country as much, so we're relying a lot on those export markets. Tariffs certainly don't help the situation.
We have a 50% increase in animal usage of bean meal currently.
And that's a good start. We're going to need a lot more than that.
Then what's that going to do with the corn, because it's taking up corn room in the diet? DDGs aren't going in either.
Yeah. I'll talk to Spawner, and I don't have a solid answer for that. Again, my expertise is more along the livestock side as far as that goes.
Wait, that is livestock.
It is, yes, sir. I agree with you. That's a little bit outside of my realm of expertise.
Other questions?
Christopher, shoot.
Thank you, Bernt. Anything interesting going on in DC these days from your perspective?
It is nonstop in DC. I think the things that have taken up more time of mine than anything else have been related to animal disease, whether we're talking about screwworm or avian influenza. We've had 5-pronged strategies introduced for just about everything you can come up with as of late. But they're a good framework, and we got to kind of see these through. I was happy to see the research dollars go out for the avian influenza research. We'll have some more information on what's happening there in around August. That'll dictate a lot of our supplies and what's going to happen that way. The screwworm situation is unfolding. We've got a site selected for a facility, at least a potential site at the moment on U.S. soil. That's a really good sign for that. That's still, even once we get that kind of started, it'll be a year out before that facility. I mean, that's an estimated time is about a year out. So we're on a race against the clock to get that here. It's definitely one of the biggest issues facing our livestock sector. A lot of concerns surrounds that, and even the wildlife situation. We got feral hogs that can move the thing through. So that's one of the top priorities as well. Labor is a nonstop discussion. You know, finding our labor and finding better pathways to obtaining labor that work for everybody. That's a consistent discussion. You know, I really think those topics are endless. HPI and dairy is starting to carry some weight again. We've had a couple of discussions about the crossovers and what that means. We've heard a little bit about that today and yesterday. So that's all things that are happening, you know, pretty readily. We just got a new economist on board. She'll be analyzing a lot of the stuff that you just discussed. She's kind of the head of that. That's been one of the problems we've had, is there's been a lot of turnover in Washington. And so seeing that happening, that makes access to information a little bit more challenging than it used to. Labor within USDA itself has been a top concern, making sure that we have people there and data. You know, we fought really hard to get the July cattle report back. I about did flips down the hallway when they announced we did get it back. So I was grateful for that. As we see things kind of transition and we keep our boots on the ground, we'll be pushing forward. It is never ending.
Well, with that, let's thank Bernt for